This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode dives into the evolution of infrastructure investing with the leading scaled specialist firm in infrastructure. We sat down in Stonepeak's Hudson Yards office with the firm's co-president, Luke Taylor, to discuss the inner workings of the infrastructure investing world and unpack the story of how Stonepeak's rapid ascent has seen the firm climb to over $73 billion in AUM in 14 short years. Luke brings a wealth of experience to the infrastructure investing world. He's co-president of Stonepeak and a member of all the firm's investment committees. He's been investing in infrastructure for over 20 years, joining Stonepeak from infrastructure investing pioneer Macquarie Capital. Luke and I had a fascinating conversation and thought-provoking discussion about infrastructure investing and why it's becoming an increasingly important part of the private capital ecosystem. We covered how Luke went from growing up on a sheep farm to investing in infrastructure in New York, what Macquarie taught him about how to approach infrastructure investing, why he took the entrepreneurial leap to build Stonepeak and join Mike Dorrell from the firm's earliest days, why infrastructure investing is more than toll roads, airports, and bridges, how there are elements of a private equity approach to investing in, building, and operating infrastructure assets, where infrastructure fits in an investor's portfolio, why individual investors should consider exposure to infrastructure assets, whether or not infrastructure has proved itself through an inflation cycle, why scale matters in infrastructure investing, how Stonepeak identified investing in data centers early on and well before the data center boom began, and what type of demeanor and mindset makes for a successful infrastructure investor. Thanks, Luke, for coming on the show to share your expertise, wisdom, and passion for infrastructure investing.
We're going mainstream.
Luke, welcome to the Alt Goes Mainstream podcast.
Thanks for having me on the show, Mike. Excited to be here.
Pleasure to be here as well. Thanks for having me in your office. I think such an interesting conversation on tap around evolution of infrastructure as an asset class, how to think about infrastructure investing. There's so many unique aspects to it. And then also just the mindset of an infrastructure investor. You've lived that and the nuances of how to think about infrastructure investing. So first, I'd love to start with your background. You've been in infrastructure for a long time. How did you end up here at Stonepeak?
It's a long story, but it's been a great journey. So I grew up in New Zealand. I grew up on a sheep farm there, and my mum was a science teacher, so I did a lot of sciences at school, went to university, and I took all finance and economics, and I really wanted to get into business. And, you know, Macquarie actually came to my university. And I knew I wanted to get in business, but I didn't quite know exactly what part of it. And Macquarie had this brochure that had a swimming pool and said, "Do you want to get chucked in the deep end?" And I looked at that going, wow, that sounds interesting. I'm up for that challenge. And so I joined Macquarie in New Zealand. And at that point, infrastructure was just starting up. Macquarie had been an early stage mover. They'd seen the benefit or taken advantage of the fact a lot of the states in Australia had got into financial difficulty, had looked to privatise assets. They'd married up a lot of the state pension fund capital in Australia with those assets as a unique solution. It's a very entrepreneurial place. And so I joined it through wanting to get into business and the excitement of a challenge, not knowing exactly what that challenge was. And infrastructure was the new thing at Macquarie, so I leapt into it. So a little bit by chance is how I came about the opportunity set. And it was a growing new sector, which I thought I could roll up my sleeves and see how I could go in it.
Early days of infrastructure, what do you think you learned most that you've taken with you today as infrastructure has matured as an asset class?
I'd say a couple of things. My experience at Macquarie, it was a very entrepreneurial organization, and they were very good at identifying entrepreneurs and then pushing them out there. So at Macquarie, if you put your hand up and said, hey, there's some action going on in this part of the world, like in 2 weeks, you'd be sent there. So I went from New Zealand, I spent some time there. Suddenly I found myself in London, and London was a startup for Macquarie. They were just trying to get their feet into the infrastructure space. So nobody knew the brand. So you're out there in a scrappy startup. And then they asked me to go and move to the US, which was a similar setup. Like they had a few people over here. They'd been doing it for 3 or 4 years and saw an opportunity set. So I turned up here in the US. Again, no brand recognition. Nobody could really pronounce Macquarie correctly. And I love that entrepreneurial environment where you've got to go to a new market and start creating a name for yourself and get scrappy and get out there and create the opportunity set. I think that's something I really learned at Macquarie. And so one thing I've always taken is, look, you want to produce like market-leading returns and differentiated returns. And if you just do what everybody else is doing, like you're not going to differentiate yourself. And Macquarie was very good on like pushing you out there to say, like, find the next opportunity, find what other people aren't finding and be scrappy. And that's something I've always taken and something we've tried to replicate a lot at Stonepeak is to make sure you got that entrepreneurial spirit of people to really be scrappy and find the opportunity and get where others aren't, because that's where you'll drive the returns.
It sounds like Macquarie made good on the promise of their advert of throwing you in the deep end.
It did, yeah, for sure. For sure. I was thrown straight in.
And then you mentioned Stonepeak and having that same mindset and DNA. That was another time when you were thrown into the deep end, or you threw yourself into the deep end. It was 2011. It was still relatively early in the infrastructure asset class, particularly in the US. You started as a completely new firm in an asset class where scale really does matter and size matters in terms of doing deals, winning deals. What was going through your mind about throwing yourself in the deep end when deciding to come and join Stonepeak and help build it from scratch?
I'd spent 10 years at Macquarie. I knew I was never going to be a long-term Macquarie person. I always wanted to get out there and either try and do my own thing or make a big impact of doing something. And Mike and Trent, who started Stonepeak, I used to work with them at Macquarie, so I knew them very well, had great respect for them and their skill set. And so they'd gone off to try and launch a business at Blackstone and then ultimately spun out to do Stonepeak. And around that time, the GFC had occurred. So we've been through 2 or 3 years of time where there'd been real stress on the asset. And there had been other managers at that point. In the US particularly, a lot of the investment banks had created infrastructure platforms. And I remember being at Macquarie just getting blown away on transactions by these new upstart firms and just sat there going, look, but people are going about it the wrong way. Like there is a gap here in the market to build a firm which is truly focused on long-term value creation within infrastructure. Because still at that point, I think a lot of the new entrants viewed it as, look, this is a low-risk asset class, buy the asset, put them in the bottom drawer, and just don't worry too much about it and collect coupons. And all my experience at Macquarie, whenever I was meeting with a management team, they weren't optimizing the businesses as well as they could, because inherently infrastructure has very good barriers to entry. And if you have very good barriers to entry, you don't have a lot of market competition, you don't have so much pressure on like driving operational value add through your business. And talking to Mike and Trent coming out of Blackstone, they'd had that Macquarie experience, which had a lot of the infrastructure IP and knowledge of the sector. And then the experience of Blackstone, which is truly focused on the value creation and being very operationally intensive and trying to marry the best of both worlds. And so as I was talking to Mike and Trent, they'd said, hey, we're going to form our own company. why don't you come and join us? We're setting up shop. And for me, it was a good timing because I wanted to get on to the next chapter of my life. And here was an opportunity to join two folks I knew well, come in at the ground floor, have a big impact on culture, start with a blank piece of paper and in a sector which I knew we could do very well. And I had high conviction in that because the opportunity set is there. And I don't think people were going around the right way in terms of what you could do from a value creation perspective. And so that was, but I also been at Macquarie where I'd gone to London, I'd gone to New York. So I love that scrappy startup environment, which appeals to me.
I'd love to unpack the point you made about value creation. What key insights did you have that could make the way you thought about helping these assets and these operators build their businesses in the infrastructure space maybe be a little bit different than the way others in the infrastructure investing space had thought about it?
I think to that point, there's not a lot of focus on value creation because the sector had grown up as toll roads and utilities is when it started. And so people sit at a toll road and say, okay, I own a toll road. I've got cars going through, they pay me a toll. The toll goes up by a certain escalator under a agreed concession. And I have 90% margins and I pay an O&M contract. So there isn't a lot operationally you can do with that on the edges. And that's where the asset class was coming from to start with. And as we expanded what we went into, more and more you meet these businesses which have got a few more operating levers with them, but because of the barriers to entry around the businesses, you'd sit there with a management team and I'd often say, okay, tell me about your KPIs. Like what do you focus on from an operating perspective? And often you'd have a management team that say, well, we've got great customers and here's how our pricing works and our pricing goes up by inflation and here's how our costs work. And I'll be like, no, but tell me what metrics, what are your KPIs? How do you operate to? What's your fuel efficiency? What's your utilization? What are your turn times on your assets? And you can just tell that data, that use of data to track operational intensity of infrastructure just was lacking in the sector. It made sense because it was coming from toll roads and utilities, which had less of that. And as you found more businesses which had really strong moats, you'd actually drive a lot of value creation.
From that perspective, where my mind goes is the mindset that you need to have as an investor. Is there a certain type of mindset? Is this a private equity mindset applied to infrastructure investing that is most helpful when thinking about how to invest in and then help build and operate these businesses?
I'd say from an investing perspective, I come at it from two sides. One, I think about how we build our team. Like we've got people out of credit hedge funds. And that credit mindset is very good on the downside protection. Like downside protection is number one. I always take the view, if you're investing in infrastructure, you should be never getting into a situation where you're going to impair your capital on an investment. Like if you've got true barriers to entry, you pay the right price, you don't use a ton of leverage, you should have a very, very low risk, long duration investment. And that credit hedge fund mindset of downside credit analysis, I think is very critical. But on top of that, marrying it with the private equity, like value creation and being operationally intensive. And so I think it's a blend of those two skill sets.
I think that brings up a really interesting question when it comes to infrastructure investing, because these assets are in many cases so long dated. You have to have such a long time horizon. You're hoping that there's long-term contractual cash flows in many cases. But yet at the same time, especially in infrastructure today, it's not just toll roads and bridges, which many people have thought of as infrastructure, but it's data centers. It's because of the AI boom. It's decarbonization. It's digitalization. How do you think about balancing the ability to think long-term and also think long-term about the assets that you're owning, but also be able to have an agile and also somewhat impatient mindset when it comes to making sure you're on the right trends at the right times?
When I think about the people that do well here, one is you got to have very good analytical skills, like rigorous analytical skills. But I think that's true for most things in finance. Like if you don't have that, you're probably in the wrong business. So that should be a given. But you've got to have relentless drive to get to the outcome. And I think that's true for both deal sourcing, but also driving the outcome on these investments. And often what we're looking for in people is, can they navigate around adverse situations? Like, have they been able to change their direction of their life? because that's the attitude you want. You want to be out there. It's a competitive market. You want to work harder than your competitors. You want to find situations where you can find good investments and have that true drive to do it, and be like absolutely focused on winning. And you got to live and breathe it day in, day out. Like, the exciting thing is the businesses you invest in are like the backbone of people's daily lives. So that's a pretty exciting part to be investing in, and certainly way easier to recruit today than when it was just toll roads. Like, I remember when I was in Macquarie 20 years ago here, very hard to recruit locally because we'd say, hey, toll roads and utilities, and it sounded pretty boring. But like today, you're investing in things that truly drive, better outcomes for people in their lives. But you've got to have that relentless drive and mindset and focus on success, because in infrastructure too, it's a slightly lower return than typical private equity. You've got a lower risk. I think it's great risk-adjusted returns. But you've got to be focused on every basis points counts. Like, if I'm driving an outcome, I can pick up 10 basis points what I'm doing operationally. I'll pick up another 50 basis points on, adding some more customers, and that compounds. And so you've got to have that mentality coming in every day saying, how am I going to keep pushing the ball forward and pick up another 10, 20, 30, 40, suddenly you got 100, 200 basis points on top of your investment, and compound that for 5, 10 years. That's pretty powerful.
I want to unpack that, because that really gets to the nuances of underwriting. How do you think about underwriting what you just discussed, making sure that you're finding where you can really add value to businesses, also where you can minimize the risk too? Because the other thing that I hear from your answer is those 50 basis points might matter. So underwriting risk properly really matters.
Yeah, that's exactly right. I'd say if we look at a investment, number one, we're trying to find businesses with high barriers to entry and very, very long-term sustainable moats. And if you've got a business with high barriers to entry, you're going to have limited competition, very few substitute, and that should have very good pricing power. So number one, we're looking for the high moat, high pricing power businesses. And you can see that. You'll focus on the history of the business. Look, it's a sector where there's 90% of the action, and there's 3 thematics, right? It's transport logistics, it's the digital communication space, and it's broadly the energy transition space. And so we have a pretty good feel for what businesses we like out there and what's got the really strong moats around them. But you look at history, you look at the margin of the business, you look at their ability over a long period of time to consistently drive pricing power, and that's a great measure of like the strength of the moat around the business. And so that's number one. We're trying to make sure we're sticking to our netting in terms of those high pricing power, strong moat businesses. And then I'd say on top of that, it's the downside protection. And it comes through a few things. There's not only the characteristics of the business, but you've got to pay the right price. Like, at the end of the day, if you don't pay the right price, you won't recover on your investment. And so once you've analysed, okay, I feel really good around the moat around the business, the pricing power, like what's the right valuation and when am I getting the right risk-adjusted returns? And so that comes down to your purchase price, a sensible use of leverage. And then what we're really looking for as well, once we feel we've got the right asset at a good price, is do we have 2 or 3 ways we can really drive right-hand skew? And that may be, we've got a pretty detailed list of what we'd like to go after. That may be the assets are slightly underutilized, and then I can add more customers. And as I add more customers to a fixed asset base, a lot of that will flow to the bottom lines and increase returns. And so it's around asset utilization and increasing customers. Is there areas I can improve the operating efficiency of the business? And we're pretty operationally intensive. We've got a full-time portfolio value creation team. We've got 25 operating partners. And so we tend to try and drive the outcomes of those businesses. And you're looking for areas where you think, okay, here's where we can expand the business. Here's where we don't think we're operating the right from a margin perspective. Here's how we can take our best practice across the 75 assets we've invested in infrastructure and apply them to this situation. And then there'll be ways we can expand the business, put new capital to build more projects, expand with customers, and that's usually a good way to drive value as well.
What have you tended to find are the biggest drivers of value creation and return?
Yeah, I'd say biggest drivers of the actual value creation, once we've bought the asset and we think there's a great way to drive the value creation, I think that focus on operational intensity, like actually laser focusing on how we're doing operations and can we do it from a better perspective, is a great driver of returns. I think another way is, it's specific to the assets, but if it's transport, route density. Like you have a very large scale moat network in a transport asset. And as you add more assets into your network and you add more customers, you get what's called route density. So your cost to serve your customers go down. And that's a great way to drive value. And we've been very successful in doing that across the transportation space. I think as well, another area is just driving that asset utilization. And often, I'll give you an example, we'd one business, which we owned early on. It was a transport business. It moved a lot of grain one way up a river system, moved a lot of refined products down a river system. And we loved that business because it was an absolute essential service to that river system, but it was an underutilized asset base because you had an empty backhaul. And so our thesis was we knew ethanol was moving around in that area and we can bring it to our catchment, build a rail spur at the top of the river system, bring it to our catchment area, load it onto our barges on the empty backhaul, increase the asset utilization, and a lot of that flows to the bottom line. So there's 4 or 5 pretty proven ways we go about it.
On the transport example around logistics and building a dense logistics network, does that often come from acquiring other assets and doing more of a bolt-on or an M&A strategy, or is that often the companies you're looking at have these dense networks, they just need to be maybe utilized in better ways?
I'd say it's a combination. So I'll use the example of cold storage. And so if I had one cold storage facility, and so cold storage is, transports all the stores and transports blast frozen food. So if I have one facility in the US, I'd struggle to call that infrastructure. I've got a series of customers there. I'm not really part of a network. My customers may move, they may not. If I own 200 facilities, that's a totally different ballgame. Like I am the scale provider in the market. I have all these deep relationships with all the food companies. I've got my asset utilization very high because I'm using multiple facilities for multiple customers and I'm embedded in the supply chain. And so my cost to serve my food customers has gone down because I've got 10 customers using a facility as opposed to 1 or 2 customers using a facility that's 30, 40% utilized. And that scale, that network effect creates an incredible barrier to entry to your customers. And so we'll go about it 2 ways. One, we'll invest in a company which has already got that scale. You need the barrier to entry to start with. And then you'll build out more within the network to just strengthen that moat over time. I think it's harder to start with something that's not infrastructure and try and M&A your way into creating infrastructure because you may not get there. You need to start with a network and densify it, and that strengthens your moat and it lowers your cost of capital to the next buyer.
I think what's so fascinating is when you share that example, my mind goes to across each of these categories, transportation, logistics, energy, and digitalization. Each of these categories are actually all network effects businesses. Many people, we think about network effects, Facebook or a social network as a network, and we see that in our daily lives, and the points of presence digitally are the network effects that we think of. But when you think about your investment strategy, to some extent, across the categories that you invest, it's very much a network effects investment strategy.
I think it's a fair observation. I'd say 1 or 2 things. Like if I look at an LNG export facility, that's a bespoke facility, long-term contracts. Maybe it forms part of a network, but you're investing in one asset that you feel very, very good and defensive about. I think on some of these bigger operating businesses, absolutely, you can have a network effect. I think the difference when I think about a Facebook has a big network effect today, but it didn't for a long period of time, right? It got to a scale where suddenly there's so many people using the network, they rely on each other. It's a little bit like a stock exchange, right? You have liquidity, so people transact there. Whereas with infrastructure, you're starting out in that very defensive position. You're not taking a bet, you're getting to that position. You're in that position to begin with, and then you can get very accretive growth within your business by just densifying your network.
I think that's a great segue into thinking about infrastructure as an investment. It's already in a defensive position that makes it a great asset. It's probably already throwing off cash and has long-term contracted cash flows in many cases. How do you think about infrastructure as an investment, and where does it sit within the context of private markets in your mind? Is it more equity-like? Is it more credit-like? Does it sit somewhere in between? How do you think about infrastructure?
I view it as, it sits a little bit in between. It's you're getting lower risk, long duration equity cash flows. It's a little closer to credit risk than it is to private equity, but you've got the equity returns. And so the way I think about it in a portfolio is, if you look at the very first people that invested in infrastructure from an institutional perspective, it tends to be the Aussie super funds. And that was back in the early 1990s. And you look at those allocations today, they've gone from starting to allocate, and most of them do double digits of their portfolio allocated into it. And then you look in the US, you're seeing a long runway where, their allocations are maybe 1 or 2%, and people are starting to move them up to say, oh, I want 3, I want 4, I want 5, 6%. And so I think those allocations will continue to go. And I think it comes from a combination of, some of it's coming out of fixed income, some of it's coming out of real estate, coming a little bit of private equity as well. I think from a risk-adjusted perspective, I think it offers very good risk-adjusted returns. And I think the unique thing about infrastructure today, it's always touted very strong inflation benefits, a very good hedge against inflation. But if you look back, before the recent bout of higher inflation, we hadn't had inflation in the US since the 1970s. So it had this theoretical, very strong inflation linkage that you could see in the pricing power and the way contracts worked. But until you actually see it, battle tested with a real shock, like how is it going to perform? And it's come through with flying colours. It's delivered on what it said. It's delivered those very attractive risk-adjusted returns. I think that's why you're seeing it as a more critical part of people's portfolio. But they're pulling from a few different parts.
Why is that? Why did it perform so well, even as inflation went up?
Because ultimately with these assets, a lot of the cash flows are linked to inflation. So as inflation has gone up, you got two things going on, right? Interest rates went up. And so when you've got interest rates going up, typically you'd have valuations come down in an asset class because your cost of capital has gone up. The unique thing with infrastructure is inflation, interest rates have gone up to combat higher inflation. Infrastructure benefits a lot from higher inflation because the cash flows your asset is generating are going up. Your pricing, instead of going up at 2 or 3%, which what inflation was, suddenly inflation's 5, 6%, you'll see a pickup in your cash flows. So it's offsetting your higher discount rate with higher cash flows you're generating. And that's what it's always touted to do, and that's what the asset class generally did through that period.
From that perspective, then, where do you think it's best, if you think about portfolio construction, where should investors take from other parts of their portfolio and put into infrastructure? Because I'm talking about this really in the context of the wealth channel is probably a net new investor into private markets broadly. Yeah. Historically, maybe a lot of them had a 60-40 portfolio, equities, fixed income. Where should they take out of a portfolio and add to something like infrastructure?
If I talk to people within the channels today, a lot of people want private infrastructure. They're seeing the yield benefits of it. They're seeing the duration. Often they're taking a little bit out of private credit. Private credit's got great yield, but it's got the reinvestment risk. So I think people see I've got great yield for 2 or 3 years, but what's that going to look like? Whereas today I can lock in long duration cash flows and I'm also getting the yield. So we're seeing some of that, but I'd say it's pulling out of that. It's pulling a little bit out of real estate, pulling a little bit out of, it was what I call alternatives bucket. And instead of private equity, I can get a lower risk, but I'm also getting that yield back through the assets, which is helpful from a liquidity perspective.
How do you think about infrastructure investing when you mentioned that? Because there's elements of private equity to some extent. There's infrastructure equity, there's infrastructure credit, there's a real estate side to things, and you have strategies across each of those. How have you thought about productizing infrastructure as an investment when you think about it, whether it's institutional or non-institutional LPs?
From a product perspective, so yeah, you're exactly right, Mike. So we do infrastructure equity, we do infrastructure credit, and we do some real estate through an infrastructure lens, which I'll touch on. And we find it's important to play in all three parts, particularly on the equity and credit side, because you want to ultimately be a good capital solutions provider. There's a ton of strategic players in infrastructure that are a very good source of deal flow. And so you want to be creative to see, okay, what's the opportunity I'm seeing today with a particular sector? And I can play the equity, but maybe there's an opportunity on the credit side. And the more information you have within the firm, the more in depth you are in a sector and seeing trends, the more good investment opportunities you ultimately see. And so the more our credit folks are looking at a sector and say, okay, this kind of looks interesting, you have the knowledge share. And it drives better investment outcomes, and you get to, earlier on theses you want to invest in. On the real estate side, we look through that from like an infrastructure lens. And I'll give you the example of a thematic there is, we love the rail network in North America. Like if you look over the last probably 50 years, trucking's taken a little bit of market share from rail, but rail is over 600 miles. It's the best route, deliver long-haul goods across America. It's a fantastic network. It's the lowest emissions form of delivery of freight. And so we'll see that continue to pick up. But it's a hard sector to transact in. There's a lot of private rail companies, but if you own one of these, people are generally not willing to part with them. They're great assets. And so we've played a lot through the real estate lens. Because we've seen great growth in the rail network, we've bought like the real estate around the rail net, like key logistics points, where we think we're going to have a higher rental growth. And so that's how we play some of the synergies between the businesses.
On that point, how much are you a thematic investor versus employing another type of mindset or strategy to investing?
I'd put it down to two things. I think we're thematic, but also opportunistic. Because I think you need to be opportunistic to drive the best outcomes. Like when there's a situation you can drive a good price on entry price, you want to be all over it. But we're always thinking of where is things going to next? Like how do you get ahead of where others potentially going to invest or where the opportunity set is? And so data centers is a great example. We invested in data centers 9 years ago. Like today, everybody wants to invest in data centers. We were the first infrastructure into data centers. And back then, you want your staff to be entrepreneurial. You want to be constantly thinking, okay, where's a good investment opportunity? And so we're always encouraging people to look around and keep your eyes and ears open. And data centers is a great example where our team, I must have bought us like 10 or 15 data center opportunities 10 years ago. And back then, the average data center was, the customers were pharmaceutical companies and financial institutions. They were the big storers of data. And you'd have some facilities in say, New Jersey, and you'd have 5 to 10 year contracts with, Goldman Sachs and Pfizer with the type customers. And we'd sit there going, this just doesn't feel like infrastructure. It's more real estate. I own an asset. I don't really have many barriers around it. I've got some cheap power. And why are the pharmaceutical companies and the financial institutions, they may renew, they may not. But our team kept looking. We said, look, we love the thematic. We like the growth there. But let's find the real infrastructure that's got the pricing power and the barriers to entry. And that's where we came across the interconnection hubs or what I call the carrier hotel part of the data center landscape, which is each city or metropolitan area has one or two of these carrier hotels. And that's where the subsea fiber comes in, the interstate fiber runs. They're the old Bell telephone exchanges that became network hubs. Very strong moats, very strong pricing power. And we invested in Cologix, which was a large player in Canada around that thesis. And so I think you want to always have that entrepreneurial culture within your staff to go, okay, let me take forward an idea. Let's bounce this around and be encouraging of that.
And that was well before the AI boom has intersected with data centers as well.
It's about 6 years before. Yeah, 7 years. I don't think we were predicting the AI boom. I think we saw the data proliferation and the starting of streaming, and we said, you know what, like the connectivity is going to be big over time, and we can get these assets at a very great price that are going to have very long duration trends that, if we get data proliferation, if that becomes bigger and bigger, will drive incredible upside. And if it doesn't, we'll get a good return.
Well, the interesting aspect of that, and I love the use of carrier hotels, because I think like there's rerouting of data from one hyperscaler to another. Somebody may be streaming on YouTube, but then they may be streaming on Netflix, and that has to reroute, right? And if you're in the middle of all of that, then you're the hub.
You're like a toll road on the internet usage.
Was that how you thought about what this actually was and created that kind of conceptual framework that this is a toll road just in a more digital context?
Exactly right. You're trying to find the sort of nexus of the hub. You could see the long-term growth, but what's the part that's going to capture the pricing power that people always have to use? Where is the moat? And often you felt the one facility in New Jersey with Goldman Sachs as your customer, do they have a moat? Maybe that's a great investment, maybe it's not. It's hard to tell because you didn't really know what would happen on a renewal. Instead, you had the asset which had every customer, 250 participants within a region have to be in there to connect to each other. And you could look back through, you just look through the history of the business, had great pricing power, very strong margins, and that's where you felt really good around the trajectory of that business.
I think that brings us to another really interesting point too, which is AI and how it relates to data centers. So investors can play AI in the trend in a number of different ways. They can invest in NVIDIA and the publicly traded companies. They can invest in private companies through venture capital or direct deals. But then they could also invest through infrastructure. They may not think of it in that context, but they're still, if they're investing in data centers, they could be getting exposure to AI.
I think it's exactly right. So I could go, if I want to invest in AI, there's a bunch of public companies I can choose, and some may be winners, some may not be winners. And some may have good moats, and there's technology risk, and there's risk of whose product is ultimately uptaken by consumers that are using AI applications. And so inherently it may be a good bet, but you've got a reasonable spectrum of outcomes. And with technology companies, some come, some go, right? Depending on new technologies creating or better products that get the uptake. We look back to what is the actual infrastructure that supports that. So regardless of who wins in the AI race, our infrastructure supports whoever the winner is, right? Like the end consumer demand will be there. And so you're going back to that hard asset base, which supports the connectivity around the globe. And so you have incredible downside protection because that's never going to go away, but you're levered to the same growth thematic. And so it's a great downside protected way to get that exposure and get it for the long duration.
That's where I wanted to go next. I think that gets to kind of getting inside the mind of how you underwrite this AI thematic or AI trend, which is, I imagine you think that there's tons of capital required to finance all the hyperscalers, what they need, and then everything above that from the foundational model layer up to all the way to the application layer. When you underwrite data centers from the perspective of investing through the AI thematic, do you think that there's such, and when we think about the numbers being thrown around, right? Like people are looking at investing in data centers for $30 billion, right? These are massive capital needs and capital outlay from the investors. How do you think about underwriting the AI thematic and as you think about it just from the opportunity set and size?
Number one is that downside protection. So it's all good to have a great AI thematic that will deliver long-term growth. What's the spectrum of outcomes? What if it's on the low end? Like how do you make sure your capital is protected? So often within those businesses, you've got very strong contractual protection. So you look at the asset, I feel really good around my customers. I've got the contractual protections there. And regardless of where I end up on a growth rate, I'm going to have very good downside protection within that asset. So my capital is protected, and that's number one. And then from there, you're going, okay, well, if that growth kicks off and it continues, what's my opportunity set and how do I capture my market share of that? And that's generally what's then driving your upside of your investment. And often for that, it may be, okay, I might have to invest some more money to build some more data centers. And that should usually be accretive because I've got a base business and I'm investing around the network. And so that's a lot of the way we think about it. It's going back to that first principles of like the downside protection. And I think in infrastructure, you often see people get caught up a bit of the hype and say, well, I've got a great thematic. But if you go and pay that away in your entry price, you'll never recover. And so it goes back to like getting a good entry price into the sector to participate in that thematic and making sure that thematic's great. You do fantastic. But if it's not, you still make a pretty good return.
On that point, how do you think about the increased amount of capital that's flowing into infrastructure? It's still a category where if you look at the top 10 funds, they raise the lion's share of the capital. Maybe that's in part because the need to finance many of these deals is so great in terms of the size and scale required to do it. But as more capital comes into the space, how do you think about navigating that from a return perspective?
I look at the private equity landscape. I mean, there's going to be over 5,000 private equity firms. So if you look at infrastructure, there aren't that many firms. And firms that have been around for a long time that have navigated the space and invested through cycles. I think it's important to remember that you may have an all up to the right-hand thematic going on in AI, but you've got to be invested through the cycles and energy. Energy has its ups and downs, transport has its ups and downs. And so you've got to really be focused on that durability of cash flow and getting the entry price right. But as you have more capital coming into the space, it is a pretty big sector. If you're on the outside looking in, you may go, wow, a lot of capital coming into the space. But if you're in the sector, the scale of the opportunities, like every country, the backbone of what everybody does in their daily lives, like, the communication we're having on this podcast between audio and video, and you've got the lights on, the electricity network, the water, like these assets are scaled and they're used in everybody's daily life. Like the opportunity set is pretty immense. And we're going on this almost rebuilding of our energy matrix. We've got the decarbonisation thematic going on. We've got the digital thematic where we're really rebuilding how we connect daily. And so it is a pretty large opportunity set for investors. They talk about something like 100 trillion of investment required over the next 10 years. And so you've got to marry that against the capital coming into the space.
How do you think about that from a capacity perspective? So you as a firm at Stonepeak, 2011 to today, you've scaled from 0 to 74 billion or so across those categories that we mentioned: infrastructure equity, infrastructure credit, real estate, and then other strategies. You have a decarbonization strategy. How do you think about the capacity that you can fill to meet some of those needs and the size funds? Because it feels like scaled specialists, there's always scaled specialists in their specific sectors, but they really can take a lot of capital in because they know what to do, how to do it, what to focus on where and how.
I think that's right. I think with infrastructure, I don't think you want to be too specialized, because if you're narrowed down to a very, very sub-segment of infrastructure, the challenge there is if your sector's out of favor, what are you doing? Like you're under pressure to deploy, and I think that leads to not so good outcomes. You want to be diversified across infrastructure so you can pick off the best thematics to go into at any time. And also, if you're a specialist across infrastructure, like you're deep in the weeds, you know your sector back to front. Also on the value creation, what you've done across assets is incredibly applicable across other assets you invest in. And so that pattern recognition of, okay, we see a situation here, here are the 2 or 3 things we can truly drive the outcome, that gives you high conviction in actually driving the outcome for investors. And so I think that's a big benefit of specialization within the asset class. And I think on the opportunity set, look, I think a lot of it, like there's just not the capital to fulfill it, right? And so the nice part about that is you can pick off the high returning opportunities.
How do you think about competition from that perspective? As you think about certain firms have raised meaningful amounts of capital, do you think at the upper end of the deal size, in some senses, is there less competition maybe because there's less firms who have that size and scale to compete for certain assets? How do you think about that whole aspect of the market structure evolving?
One challenge, I think, in infrastructure, I don't think you want to be so big that the assets become so large that you haven't got the ability to ultimately exit them. So I think you need to be quite cognizant about that. I think it's an opportunity. It's an asset class where you're seeing more and more interest. So there will be more participants and opportunity to exit. It's also hard. It's hard to become a new entrant in an asset class. Like once you've got the teams out there and the scale, and we play, between the middle market to sort of the bottom of the large cap, it's very hard for people to compete with that because we've got the scaled network of opportunities that come in. So I think the scale, not necessarily on the opportunity size, it's the breadth of your network for sourcing opportunities and getting ahead of the ball before your competitors. And I think by having a very deep network of investment professionals that really know, like the staff here, they know back to front every CEO, every CFO, every operating officer in each of the companies in their space, and they're constantly pitching ideas and talking about it. So when those strategics need capital or have an idea, we're sort of Johnny on the spot to try and transact. And so I think that's the benefit of the scale.
What do you think is the best way to develop an edge when it comes to origination?
You've got to be an absolute subject matter expert. I think, especially when you're partnering with corporates, they want smart partners. They want people that can bring the value creation edge to it. And so if they've got an asset and you're going to partner with them and build it, you've got to have the reps of like, here's how we've done it. And people often look at Stonepeak and go, well, you've been around for a long time. You've invested right across the space. You've created a ton of value within your portfolio. I think bringing that to bear when you're sourcing. And I think it's having like really hungry investment professionals who are out there and getting ahead of the competition and being thematic and spotting the opportunity. And so I think it's a combination of that. And I'd say too, having the credit hedge fund mindset, we're big on the use of structure, which has been a great way to unlock transactions. Like there may be a transaction where the counterparty doesn't want to necessarily part with all the equity because they don't love the valuation or they see more upside, and so they want to keep a piece on, and therefore you can use some structure to unlock that transaction. I'd say 30-40% of our deals have some structural element, which has been very helpful on deal sourcing and creativity, which I think unlocks it.
You think as more capital flows into the space, they will be looser on structure and try to compete in that sense to win deals, especially if they're maybe slightly newer entrants or they have to raise bigger funds to do so? How do you think about that whole evolution of this space?
Yeah, potentially. Oh, I think with all these sectors, right? It's infrastructure's front and center, so it attracts more interest. You're seeing large firms who aren't in infrastructure are trying to get into infrastructure. So you'll see a bit more competition pick up. But the opportunity set's big, and I think if you're a trusted partner to a lot of corporates, there's plenty of deal flow out there to go and do, and the capital needs are immense. That's what I think people often miss. It's not like private equity where there's an opportunity set to buy companies and do something with them. You've got that opportunity, but also you're always building new things. Like we've just kicked off the build of a new LNG export facility. Like it's a $20 billion new build. So there's always like new assets that are being created within infrastructure to get behind.
You mentioned exits. I think that's a really interesting way to look at this evolution of the asset class because the space has gotten bigger, deals are bigger. So therefore, the question becomes for exits. Who becomes the next net new buyer? For really big deals, who do you think becomes the next net new buyer of many of these assets?
And that's one of the reasons we've tried to stay and not get right to the large cap, because I do think you end up having assets which, do people start saying maybe I have to put that back to the public markets, which is always can be a tricky way to do it. Can you go down the path of continuation vehicles, which, are you selling stakes at 5-10%? I think that takes a long time, and I think you want to be driving a good outcome on your exit rather than being in a situation where you've got really one option. So I think that's one of the risks out there.
The other interesting and maybe slightly more philosophical aspect to this too is as we see this advent of evergreen funds, particularly in the wealth channel, I go back to the conversation that we've had, conversation with Mike, where many of these assets may be great to hold over a very long period of time. Mike mentioned Warren Buffett. I think his biggest asset was railroads.
Yeah.
Right? And when you think about that might be an asset you'd want to hold for a very long time. Do you think the advent of evergreen structures actually changes the complexion of how infrastructure investors may end up thinking about holding their assets? Now, there obviously has to be a growth question, right? If the asset doesn't grow as much as you'd like it to, then maybe it's time to exit that asset, and there still needs to be exits, whether it's in an evergreen structure or not. But does that change the way that infrastructure investors may think about buying and holding and exiting assets?
What I love about the evergreen space is the innovation and what's going on there, and particularly with infrastructure, because exactly you can own an asset like the railroad, and then the investors can choose when they want their own liquidity, and so the asset is there for like generations for people to invest in, and then you have a semi-liquid structure, which I say, great, I just want to invest for 8-10 years, and so I'll put in my money, and then I can redeem out of it at some point in time. And I love the technology and the innovation around that, because it's bringing infrastructure to the private investor to be able to invest in and have some choice over their liquidity, but the asset itself will continue to compound and grow for a very long time.
I think it's a great segue to how you've thought about conceptualizing the wealth business at Stonepeak. You've obviously evolved as a firm, and now you're really thinking about building out a business specifically for the wealth channel, Stonepeak Plus. What was the driving force behind that and the mindset in terms of how you want to create this business, and how do you want it to reflect the business and the DNA and values that you've built at Stonepeak?
We've always wanted to be able to allow private wealth individuals to invest in infrastructure. And the reason being, I always tell everybody, like, if I could hold something forever, in my 401k, like, what not better than infrastructure? Like, I've got long-term compounding cash flows, pricing power, and businesses that aren't going away. That's perfect for holding for retirement. And you can see it, like the state pension plans in North America are big investors, and so they are allocating money for people's pension fund to infrastructure, and those allocations are increasing. So why shouldn't private wealth individuals have that same opportunity to put something which is very long duration, great risk-adjusted returns as part of that investment portfolio for retirement. And so that's always been our desire. You've got to look at how the private wealth individual invests, and it's a lot different to an institution, where the institution, large, sophisticated operation from an investing perspective, and can manage various commitments and is quite comfortable in that drawdown structure. A private wealth individual says, look, I want to make my investment decision on infrastructure and I want to go and invest today. And so having the advent of the evergreen structures has been important. And so we've always had that desire to do it, but you can't do it until you've got a scaled business. And it goes back to that scale of like cadence of deal flow. Because when an individual invests, I get drawn my money in, I want to go in on a monthly basis. You need investments to happen for me to get drawn into. And they've got to be high quality investments. Like there's no substitute for high quality. So we've always had this in the back of our mind for a number of years, but we only ever want to do something if we can do it to the absolute best of our ability and create a market leading investment experience for those people, those investment partners going into it. And so that has been a lot of what get to the point we've got some scale, have a balance sheet where we can actually have some seed assets to create this product. And we're big believers in small team wins. We said, okay, we've now got the cadence and the size, and let's put a small team on it to make sure it's the slice of the best of Stonepeak that people can invest in.
How do you want to be different in terms of how you build the wealth business?
We want the investors that go into it to go, Stonepeak has delivered fantastic risk-adjusted returns and been a fantastic experience from them, and sit back and be the market-leading platform out there. At North Star, when we did it, was the important thing to make sure that that product gets allocation, gets a slice of everything we do, like the best of Stonepeak. It's not, hey, here's a private wealth product and here are some deals for private wealth to go into that's run by a separate team and we'll see how it goes. We take ourselves as stewards of people's capital, and it's a very important responsibility, and we've got to deliver the right outcome.
I think you bring up two really interesting points in there that are so critical to the wealth business and the creation of the right investment solutions or products around that. One is, how do you make sure, you say you're enabling the wealth channel to access the best of Stonepeak? That means making sure they have access to the same deals that the institutional partners that you work with have. That's not just a matter of the wealth business itself, all the way from the product manufacturing to the investment committee on the evergreen funds to the distribution, figure out how to adjudicate that, but it's also a firm-wide initiative, right? The investment teams have to be aware, they have to think about that when deal sizing, they have to think about that when they have deal flow. How do you make sure that the entire firm is fully bought in and aligned culturally to adding another component to the business?
Comes down to communication and having an entrepreneurial team and communicating your vision. And I think the nice thing about having new businesses as well, we will say to people, the people that come in today within our firm are leaders of tomorrow. Like you want to provide your staff a path to drive outcomes in the future. And so I think with opportunities like this, it's like, hey, we've gone about, we've created a small team, we've created a new product. We think it's a fantastic initiative for the firm because it's truly democratizing infrastructure for private wealth investors. And we've had private wealth investors already in the business in the institutional drawdown funds, but it's not a structure they like. They want to go into the evergreen structure. It's just a better structure of private wealth investors. And so you've got to communicate your vision, but everybody's very bought into, look, at the end of the day, you're driving the best outcome on deals. And that's what gets our deal team and investment team up in the morning saying, I'm going to go out there and drive the best returns I can.
What do you think has been the most challenging aspect of starting a wealth business from scratch?
I think that the challenge was we had an idea, we knew there was demand. Like I would bump into people I knew all the time who would say, hey, you're in infrastructure, I'd love to be able to invest. And I'd say, well, kind of hard. And so I think navigating the right structure and plumbing to be able to bring that and having the right team around it. I think we've been fortunate that we got a small team together that's truly like entrepreneurial.
I think the other aspect, which is reflective of what you just said, which is making sure that you're scrappy, always working hard, thinking about what the end client wants, is around something you mentioned earlier, which is deal flow. I think that's the other aspect of building a wealth channel solution set that's so important. It's not just about the product construction, but you have to have the right ingredients to put into the product construction, and that really comes down to deal flow. And I think that's going to be an increasingly important aspect of how the wealth channel evaluates platforms is, do they have enough deal flow to support an evergreen structure? Because if you don't, then you have all sorts of incentives that can go awry and get out of whack. How do you think about the deal flow perspective as it relates to A, just the broader Stonepeak platform, but B, the wealth channel specifically? Because deal flow you need to have enough to make sure it fits what's required for the evergreen structures.
Yeah, and there was a little bit of the point I was making before is we've always wanted to create a product where private wealth investors can get access to infrastructure. But when you're a smaller firm, you don't have the deal flow, the cadence of deal flow to be able to create that. And so once we've got to scale where we have, we've got 5 different products within infrastructure. And so we've got pretty regular deal flow. Just in the last 2 months, I think we've done like 7 different deals. We've probably, I think there's been like 20 billion plus of transaction volume in the last 7 or 8 weeks. And so that cadence of deal flow, I think, is very important for delivering it, because I think where these things can fall over is you start it, you raise the money, and then you don't have the deal flow for it. And then if people are sitting there in cash, like they might as well hold the cash themselves.
Just because you mentioned that volume of deal flow and in a recent time, that's a lot of capital deployed. Is there something structurally about the market that's made you decide to deploy so much capital at this point in time? Or sometimes maybe it rains, it pours, and other times there's not as many deals that you'd like?
I'd say at the moment, particularly in the US, I mean, there's a ton of great opportunities. And we always, volatile markets, we always find way more opportunities because people are always like under a bit more pressure. They need to transact quicker, and like our best investing has always been done in volatile markets. And so you've seen that in the last couple of months. So I think that's a bit of a function of that. But the deal flow is pretty good regardless, but definitely picks up a lot when there's volatility.
What do you think is the hardest part of infrastructure investing?
I think where people can get it wrong is if you're getting a very, very long duration bond with not much pricing power, that can be a pretty dangerous place to invest in a low interest rate environment. And where people have gotten it wrong is poured into areas where they've said, hey, this is low risk because it's low operating risk, and I've got a very long duration cash flow. That's pretty sensitive to interest rates. And so I think with an infrastructure, you always need to be very careful of like your interest rate risk, what's your pricing power. And if you're buying a very long duration bond and interest rates are low, like that's going to put you in some trouble. I think people miss somewhat of the valuation risk often in some of these sub-segments of it. I think that's something to look out for. Like there's opportunities out there. It's picking off the right opportunities where you can create the deal flow, create the right investment outcomes. Because if you just want to deploy money in infrastructure, there's plenty of deals. You can go on auctions and do that all day, but you're not going to produce the market differentiating return. So I think it's keeping the team hungry to keep pushing the edge to find the best returns.
So on that point, I like to ask people in closing what their favorite or most interesting opportunity is in the asset class or strategy within which they sit. So going forward, what is your favorite or most compelling, or maybe second favorite because you don't want to share your first favorite with everybody. But what are you most excited about it in infrastructure going forward?
If you went back to when I started in infrastructure, it was a backwater, right? When people asked you what you did, nobody really, when you said infrastructure, they thought you like some computer infrastructure or IT infrastructure. I think the exciting part is the thematics which have emerged over the last 5 or 10 years are truly like going to be around for a long period of time, and they're going to reshape the globe, and being part of that, I think, is incredibly compelling. I love the idea, and now we've been able to execute on it, of actually bringing that opportunity set to private wealth investors. And this is maybe moving aside away from the thematics, but I think the innovation and technology going on in that space, where you're moving to model portfolios and truly being able to get people exposure to something, which I think is a great risk-adjusted return. I think the innovation we're seeing in that space, I think, will be fantastic for infrastructure. I think as far as it goes to thematics, look, I think, where's the next thing after AI? Everybody's pouring into hyperscalers. We've avoided a little bit of the large language model training hyperscaler bit. We're pretty bullish on the inferencing workload, which is where consumers like us pick it up, and that's been a thematic. I think supply chain's often overlooked, and that's been a great place to invest. And I think we'll see, as we reroute supply chains. The US is trying to do critical minerals here. Who knows if in 5-10 years' time there's enough defensiveness of a supply chain to make that interesting. So, we're always evolving.
I think that's so fascinating because it shows evolution of infrastructure as an asset class. The other thing in there that I think ties so much of what we talked about together is the fact that, particularly as it relates to private wealth, I don't think you can decouple the distribution evolution from the technology market structure revolution that's happening. And that those things are related. You mentioned model portfolios. That doesn't happen without the infrastructure. But what's fascinating about that is if you take that example, that actually is very much like infrastructure, what we talked about with data and infrastructure investing, and we talked about with data center. Without the data center assets and investing in the infrastructure, you couldn't have all the commercialization and applications that are being built with AI. And that's very emblematic of those things. And we're seeing the same thing happen in private wealth. Without the infrastructure from a technology perspective, you couldn't build evergreen funds to distribute and work with the wealth channel.
So you can invest in the evergreen funds and get access to the thematic that's actually supporting the distribution of it.
Exactly.
So it all comes full circle.
Exactly. And it's tied together by all the aspects of network effects that we talked about, not in every infrastructure investment, but I think that was a theme that really was threaded through so many aspects of the conversation that I found fascinating, was how much you have to think about network effects and what that means. It was true with AI and data centers, true with supply chains. So many of those things are tied together, and I think that this was such a fascinating conversation to put all those pieces together.
No, I really enjoyed it. Thanks for having me on the show, and was delighted to be here and talk a little bit about the asset class. So thanks very much.
Likewise, Luke. Thanks so much for coming on the show. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot, and have a great day.
We're going